Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Esperion Therapeutics Inc. annual report. Esperion Therapeutics Inc. is a pharmaceutical company that specializes in developing and commercializing medicines for patients with elevated low-density lipoprotein cholesterol, LDLC, in the United States. The company's primary focus is on creating non-statin medicines to treat primary hyperlipidemia in adults. The company offers several products, including NEXLETOL and NEXLIZT tablets, which are oral, once-daily medications that lower LDLC levels. These products are designed for patients with heterozygous familial hypercholesterolemia or atherosclerotic cardiovascular disease who require additional lowering of LDLC. In addition to its marketed products, Esperion Therapeutics is also developing NILEMDO and NUSDNDI, which are innovative treatments that target cholesterol biosynthesis and upregulate LDL receptors. These products have the potential to lower LDLC levels and reduce cardiovascular risk. The company has established partnerships with several leading pharmaceutical companies, including Daiichi Sankyo Co., Limited, Otsuka Pharmaceutical Co., Limited, and Daiichi Sankyo Europe GmbH, through license and collaboration agreements. This strategic approach enables Esperion Therapeutics to leverage its expertise and resources to bring new treatments to market. Overall, Esperion Therapeutics is committed to developing innovative medicines that address the needs of patients with elevated LDLC levels. Its focus on non-statin therapies and partnerships with leading pharmaceutical companies positions it as a key player in the treatment of primary hyperlipidemia. Esperion Therapeutics, Inc.'s stock price has skyrocketed by over 74% in the past year due to a series of positive financial results, strategic developments, and anticipated regulatory milestones. The company's strong Q2 2025 earnings, which exceeded expectations with an EPS of -$1.02 and revenue of $82.4 million, marked a significant turning point. This was followed by robust Q3 2025 revenue and outlook, where Esperion reported a 69% year-over-year increase in revenue to $87.3 million. The company's confidence in its financial trajectory was further bolstered by agreements with 4 generic manufacturers, securing patent protection for NEXLETOL through April 2040. Additionally, the announcement of Q4 and full-year 2025 results showed a substantial 144% year-over-year increase in total revenue to $168.4 million, and a 21% increase for the full year 2025 to $403.1 million. The anticipation of U.S. guideline inclusion for Esperion's bempedoic acid products in the first quarter of 2026 was also a significant catalyst, as positive results from the CLEAR Outcomes trial improved the chances of favorable inclusion. This could structurally change prescribing behavior and payer dynamics, further driving adoption and growth. Overall, Esperion Therapeutics' stock price has skyrocketed due to its strong financial performance, strategic developments, and anticipated regulatory milestones. Esperion Therapeutics, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $3 billion. Esperion Therapeutics, Inc. trades at a lower price-to-book ratio of -1.23 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 213% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The financial performance of the company has been marred by declining net income and profit margins. The primary reason for this decline is the loss of branded product sales to generic versions of its bempedoic acid and ezetimibe combination tablet. This shift in market dynamics has resulted in a significant decrease in revenue, leading to net losses incurred in each year since inception. The accumulated deficit as of December 31, 2025, stands at $1.6 billion, indicating the severity of the financial strain on the company. Furthermore, regulatory challenges and uncertainty are expected to further impact net income, exacerbating the decline. Additionally, pressure to reduce prices of certain pharmaceutical products paid for by Medicare is also anticipated to decrease profit margins. The operating losses are expected to continue in the immediate future due to commercialization efforts and research and development expenses. This trend suggests that the company will need to adapt its business strategy to mitigate these challenges and stabilize its financial performance. The financial performance of a company can be evaluated through its ability to generate operating cash flow. In this case, there seems to be conflicting information regarding the company's operating cash flow for the year ended December 31, 2025. According to page 98, the company is generating negative operating cash flow with a net cash used in operating activities of $13.1 million. However, on page 99, it is stated that the company generated positive operating cash flow for the same period. The most reliable source, page 122, confirms that the company is indeed generating positive operating cash flow. This inconsistency highlights the importance of verifying information from multiple sources to ensure accuracy. Despite the initial discrepancy, the final confirmation on page 122 leaves no doubt that the company is producing a positive operating cash flow. Esperion Therapeutics management is optimistic about the company's outlook despite some challenges. The management expects research and development expenses to remain consistent in 2026, indicating a stable investment in innovation. This stability is also reflected in the company's collaboration agreements with third-party companies, which have generated significant revenue. The recognition of $91.1 million in collaboration revenue from the Otsuka agreement in 2025 is a notable highlight. Additionally, the repayment of the 2025 notes in full for $54.9 million demonstrates the company's ability to manage its debt obligations effectively. However, management has identified a material weakness in controls related to inventory accounting, which requires attention and improvement. Overall, Esperion Therapeutics management is focused on maintaining stability and generating revenue through collaboration agreements while addressing some internal control issues. The company's strategy appears to be centered around innovation, partnerships, and effective financial management. The company has made several strategic moves through acquisitions and divestitures in recent years. In terms of acquisitions, the company acquired Esperion Therapeutics Inc., a significant move that is expected to bring new opportunities for growth. This acquisition demonstrates the company's commitment to expanding its capabilities and presence in the market. On the other hand, the company has also made several divestitures, which include Accord Healthcare Inc., Alchem Laboratories Limited, Aurobindo Pharma Limited, Dr. Reddy's Laboratories Inc., Hetero USA Inc., and Micro Labs USA Inc. These divestitures suggest that the company is streamlining its operations and focusing on core areas of business. Overall, these acquisitions and divestitures reflect the company's efforts to adapt to changing market conditions and optimize its portfolio for long-term success. Based on the extracted summaries, it appears that the company has made a clear stance regarding dividend payments. The company has explicitly stated that it does not intend to pay dividends on its common stock in the foreseeable future. This statement is repeated across multiple pages, including page 71 and page 89. Furthermore, there is no mention of share buybacks in any of the extracted summaries. It can be inferred that the company's focus is on other areas of investment rather than returning value to shareholders through dividend payments or share repurchases. The company's reliance on contract manufacturers and sole-source third-party suppliers raises significant concerns about inventory buildup and supply chain disruptions. One major concern is the transfer of manufacturing responsibilities to DSC, which could lead to delays and inefficiencies in production. Additionally, the company's dependence on a single supplier increases the risk of commercialization efforts being harmed if they are unable to meet demand in a timely manner. Furthermore, geopolitical developments between the U.S. and China pose a significant threat to the supply chain, with potential tariffs, trade restrictions, and regulatory requirements causing delays and disruptions. The uncertainty surrounding these developments adds to the risk of downstream adverse impacts on entities having commercial relationships with biotechnology providers from designated biotechnology companies of concern. The company's internal control over financial reporting also raises concerns about inventory management, with a material weakness identified in relation to inventory held at a third-party contract manufacturing organization. This weakness could lead to inaccurate or incomplete information about the company's inventory levels and potential supply chain issues. Finally, the increase in inventory levels from $94,491, 2024, to $105,124, 2025, suggests a buildup of inventory that may indicate potential supply chain problems. Overall, these concerns highlight the need for the company to address its reliance on contract manufacturers and sole-source suppliers, as well as its internal control over financial reporting, to mitigate the risk of inventory buildup and supply chain disruptions. That concludes the financial summary for Esperion Therapeutics Inc. Feel free to comment below, and I will be happy to answer them when possible.